What if the biggest investing mistake isn't picking the wrong stock, but waiting too long to start? Most Americans think they need more money or perfect timing before investing. That's exactly why many people fall behind. The truth is, the right order matters more than the perfect investment, and one overlooked step could cost you hundreds of thousands of dollars over your lifetime. Welcome to American Dream Finance. Today, you'll learn the smartest order to invest your money, avoid the biggest beginner mistakes, and build lasting wealth. Stay until the end because I'll share the simple action plan you can start using today to move closer to financial freedom.
Start investing early. The hidden cost of waiting. Compound growth. Most people believe the biggest investing mistake is choosing the wrong investment. It isn't. The biggest mistake is waiting too long to begin. Many Americans spend months or even years trying to find the perfect investment. They compare ETFs, they read market predictions, they watch endless YouTube videos. They wait until they feel ready. But while they're waiting, time keeps moving. And in investing, time is one of your most valuable assets. Here's why. Every dollar you invest has the chance to earn a return. Then those returns can start earning returns of their own. This is called compound growth, and it becomes more powerful every single year. Imagine two people. Both invest $500 every month. Both earn an average annual return of 8%. The only difference is when they begin. One starts at age 25. The other waits until age 35. The person who started 10 years earlier can end up with hundreds of thousands of dollars more by retirement, even though both invested the same amount each month after they started. The earlier investor didn't win because they were smarter. They won because they gave their money more time to grow. This is the part many people miss. When you delay investing, you're not only delaying your contributions, you're delaying every future year of compounding. Those lost years can never be recovered. Many first-time investors also believe they need to understand everything before investing. That isn't true. You don't need to predict the market. You don't need to find the perfect stock. You don't need to wait for the right time. You simply need a solid long-term plan and the discipline to begin. In the United States, history has shown that investors who stay invested for decades have generally been rewarded more than those who constantly wait for the perfect opportunity. Time in the market usually matters more than timing the market. That doesn't mean every year will be positive. Markets rise, markets fall. Corrections happen, bear markets happen. But long-term investing has always been about staying consistent, not being perfect. The greatest risk isn't market volatility. The greatest risk is never getting started. Knowing that starting early matters is only half the battle. The real question is, how do you start the right way? Many people think investing begins with picking stocks. It doesn't. The smartest investors build a simple system before they chase higher returns. Step 1, build your emergency fund first. Before investing, make sure you have money set aside for unexpected expenses. A car repair, a medical bill, a job loss. These things happen. Without emergency savings, you may be forced to sell your investments at the worst possible time. That's why most financial planners recommend saving 3 to 6 months of essential living expenses before investing aggressively. An emergency fund protects your investments from becoming emergency money. Step 2, never ignore your 401k match. If your employer offers a 401k match, this should usually be your first investing priority. For example, if your company matches 100% of the first 5% of your salary, contribute at least enough to receive the full match. That's part of your compensation. If you don't claim it, you're leaving money behind. No stock market strategy can consistently guarantee an instant return like a full employer match. Free money should always come before chasing higher returns. Step 3. Use tax-advantaged accounts. After getting the full employer match, Look at accounts that help reduce taxes. For many Americans, these include a Roth IRA or a traditional IRA, depending on their income, tax situation, and long-term goals. The investment itself is important, but where you invest can be just as important. Two people can buy the exact same investment. One keeps more of the profits because they used a tax-advantaged account. The other pays more taxes simply because they chose the wrong account. Keeping more of your returns is just as valuable as earning higher returns. Step 4. Invest consistently. You don't need thousands of dollars to begin. Many successful investors simply invest a fixed amount every paycheck. This approach is called dollar cost averaging, or DCA. When prices are high, your money buys fewer shares. When prices are low, it buys more shares. Over time, this removes much of the emotion from investing. Consistency beats perfection. Step 5. Keep your strategy simple. Many beginners believe they need dozens of stocks. They don't. For most long-term investors, a low-cost diversified index fund, or ETF, provides broad market exposure while keeping costs low. Instead of trying to guess tomorrow's winners, you're investing in the long-term growth of American businesses. Simple investing often outperforms complicated investing over the long run. Key takeaway: don't wait until you know everything. Build your emergency fund. Claim your full 401k match. Use tax-advantaged accounts like a Roth IRA or traditional IRA when appropriate. Invest consistently, then let compound growth do the heavy lifting. Small actions, repeated for many years, can create life-changing financial results. You don't need to become an investing expert today. You simply need to take the first step. The biggest difference between people who build wealth and those who don't is rarely intelligence, it's action. Thousands of Americans spend years saying, "I'll start next month. I'll invest after I make more money. I'll wait until the market feels safer." Unfortunately, the market never sends you an invitation saying, "Now is the perfect time." There will always be uncertainty. There will always be headlines predicting a crash. There will always be someone telling you to wait. But successful long-term investors understand one simple truth: waiting has a cost. That cost isn't just the money you didn't invest, it's the years of compound growth you can never get back. So here's your action plan. Action 1. Calculate your monthly budget. Know exactly how much money comes in each month. Know where every dollar goes. You can't build wealth if you don't know your cash flow. Awareness creates control. Action 2. Build or finish your emergency fund. If you don't already have 3 to 6 months of essential living expenses saved, make this your first financial priority. This creates stability and helps you avoid making emotional investing decisions during emergencies. Financial confidence starts with financial security. Action 3. Enroll in your employer's 401k. If your employer offers a 401k match, contribute enough to receive the full match. If you're already contributing less than the full match, increase your contribution as soon as your budget allows. Don't leave part of your paycheck unclaimed. Action 4. Open the right investment account. If you're eligible, consider whether a Roth IRA or traditional IRA fits your financial situation. Choose the account based on your income, tax situation, and long-term goals, not because it's the first option you saw online. The right account helps you keep more of what you earn. Action 5. Automate your investing. Set up automatic contributions every payday. Even if it's $50, $100, or $200 per paycheck, consistency matters more than starting with a large amount. Automation removes emotion and builds discipline. Your future wealth is built one automatic contribution at a time. Action 6. Stay invested for the long term. There will be market corrections. There will be recessions. There will be periods when your portfolio loses value.
Don't confuse temporary market declines with permanent failure. Historically, investors who stayed invested through market cycles have generally been rewarded over long periods of time. Patience is one of the highest return investing skills you can develop. Final key lesson. If you remember only one thing from this video, remember this. Building wealth isn't about finding the perfect investment. It's about following the right order. Start with a solid financial foundation. Protect yourself with an emergency fund. Capture your full 401k match. Use tax-advantaged accounts wisely. Invest consistently. Trust compound growth. And give your money the one thing no one can ever create more of: time. Because the best day to start investing was years ago. The second best day is today.